Hi there, eToro. It is Monday, the first Monday of October, and that means it is time to take a look at what moved the markets last week. Now, unfortunately, the bug in the eToro charts continues to be a bug. So I can't show you within eToro my performance versus the S&P 500. So you can go and verify it yourself, or you can trust me. The S&P 500's 12-month return is roughly 29% for the 12 months gone, whereas mine is 38%. Just a general perspective. So last week we saw oil prices rallying, and that's because a few different factors have come together. It looked as though that rally was going to die down, but a few other things have come together this week, meaning that the price of oil is sitting pretty high at the moment. Nevertheless, I used the opportunity to cut my positions in British Petroleum last week, just taking some profit there. I also trimmed my positions in AMD, Rolls-Royce, and Cineworld, just again to take some profit and build a bit of a cash position in case there was some turmoil. And we saw some turmoil towards the end of the week, so I spent some money, although I still have some cash on hand. In terms of September, I put out a post last week. The back-end chart was this one on screen. So the candles are the S&P 500 and the orange line is the NASDAQ 100. September saw the S&P 500 as well as the NASDAQ 100 with their biggest loss since March 2020, which was when the big crash happened last year, for those of you that might not have been around then. I created this chart because last year in September, we saw a similar thing, a pullback in the market. And September, historically, by the way, statistically speaking, is the weakest month of the year. And then in October last year, we also saw a bit of weakness after what looked like a rally from the bottoms in the second half of October. Now, the point of me putting this together is that this is not my first rodeo. I've seen this type of thing that happens every year, usually several times a year, actually. And as you can see, subsequently, last year, there was a pretty decent Q4 rally, which is usually called the Santa rally. It's not uncommon to have a rally through Q4. Now, what we've seen recently is, since the beginning of Q3 2021, the NASDAQ and the S&P 500, or NASDAQ 100 and the S&P 500, finished the quarter more or less where they started it. This is really good news. This is very healthy. Investors were getting nervous, and when investors get nervous, they don't like to buy into a rally. And so when we need a decent sell-off for things to come back down to earth, before investors are happy, comfortable buying into stocks once again. So some of the heat has been taken out. Pretty good news. If we look back just 1 week, you can see the patterns in terms of selling. So technology took a bit of a clobbering over the past week. The FANGs haven't done very, very well. Energy did quite well on the back of the oil prices that I mentioned, but also because there's something of an energy crisis that's been brewing. And that means elevated prices in certain types of things used within the energy industry. Entertainment has done fairly well, but there's a sea of red just about everywhere else. I guess banks have done pretty well too. So it was a bit of a tough week in the last week of September, but I'm very happy that we saw a fairly broad sell-off, and one that took the market as low as 5% in terms of the S&P 500 and a bit lower for the NASDAQ. Okay, so taking a look at the UK. Sentiment towards UK is not great at the moment. More recently, we've heard about fuel shortages, which everyone was saying weren't fuel shortages. Talking about fuel shortages seem to have created fuel shortages, similarly to the toilet paper shortages of 2020. And also there is an energy crisis, which is a bit more real, created by certain big bad events that happened in a very small amount of time. But I think we're at the beginning of resolving those, actually. So the UK is being viewed quite comically by the world at the moment, but there has been some good news out of the UK. So UK stocks through last week, they saw a bit of a sell-off, but actually they were a lot stronger than in terms of their performance than US stocks. One of the weakest UK stocks, though, one that I am invested in, is ASOS. So they saw a pretty chunky sell-off last week, which coincided more or less with Boohoo, who are another online retailer, posting their earnings. The stock price for Boohoo took a hammering, and ASOS over 2, maybe 3 days also lost a decent percentage in terms of share price. Boohoo confirmed what people have been worried about for a while in terms of these types of businesses, including ASOS, and that is that the supply chain issues that we're having are going to be hitting profit margins. So Boohoo has warned that they're not going to do as well as they thought they would for the upcoming periods, but also that this is probably a temporary thing. So now all eyes will be turning to ASOS to see how big this impact has been on them too. I suspect that the sell-off that has been happening in ASOS has already been pricing in a profit margin issue and then some. So I don't expect ASOS to drop much further. And as I've said before, I think that ASOS is probably worth about double what the share price is right now. So while the world is laughing at the UK, we got some economic data out of the UK. Last month's economic data pointed to a bit of a stumbling point in the economic recovery. However, GDP growth in the UK, the data that we got last week, was better than expected, which is great. And also manufacturing PMI, the number came in higher than expected and is firmly within the expansion part of the range. So that's good. Potentially we're just continuing with the economic growth that was happening already, and once in a while there will be a bit of a negative blip in the data. However, the supply chain issues that we're having the shortage of workers for farmers and truck drivers, I think might also start coming up in the numbers. So maybe we won't get that 7.5, 7.6% GDP growth that they have been forecasting through this year, but instead the growth is slower but more extended, so over a longer time frame. Some really good pieces of news out of the UK too are that the travel system has been simplified. So traveling will become a lot easier and cheaper for those that want to travel from today. And through the remainder of this month, it'll continue to become easier. More countries will be taken off of the red list. I think the red list will become a very small number of countries by the end of this month, meaning that travel companies will get a bit of a revenue injection that they sorely need. So that's pretty great news. And lastly, in terms of coronavirus, so I know lots of people use different data sources. I like to just use the government data source. So case numbers, which is what the media seems to push a lot of the time. These have been lumpy after the recent peak that we saw, going up and down. But what I really like to see is the number of deaths within 28 days of a positive test, and the patients admitted into healthcare have been dropping off sharply. This is fantastic news for obvious reasons. It means at an individual level, things are getting better. But it also means that at a country level, the plan of vaccinating a very large portion of our population seems to be working quite well. Now, schools have reopened and we're going into autumn, so people will be spending more time indoors, more time close together, and so we have yet to see how seasonality is going to affect these numbers. But all in all, it looks like the plan and the UK is working, which means that it should work globally. We need to get everyone vaccinated. Okay, on to the US. So there have been some headlines that have been emphasized through the past week in the US. One of them is the debt ceiling, which I'm not going to go over again because I did that last week. There's also the stimulus bill that they're trying to get through government, which is making slow progress, but does seem to be making progress. I mentioned that the S&P 500 and the NASDAQ 100 had their worst month for quite a while. It was a bit of a close race for the NASDAQ 100. In September of last year, the index sold off by 0.01% less than this time around. the sell-off last month was nothing to be sneezed at. It was a decent sell-off. It was a healthy sell-off. I know that we looked at the 1 week performance, and actually the 1 month performance of the S&P 500 isn't that different. It's just that the numbers are a bit deeper red. So over the past week, things fell. And over the past month, we've seen a similar pattern, but it has been a lot deeper. So as I said, healthy correction in both major indexes. The performance of the indexes, however, hides what has actually been happening beneath the surface. So I just wanted to point this out very quickly. The FANGs, and so that's one company per letter. So these 5 companies make up about 19% of the S&P 500. These companies also tend to be the companies that investors run to when they're seeking safe growth. So lots of money tends to run to these stocks when there is volatility, and these stocks end up moving the S&P 500 as well as the NASDAQ and the NASDAQ 100. What we don't see when these indexes move like this is that there are lots of smaller companies in these indexes whose stock prices have been in correction territory for much longer than a month. They're not down 5%, they're down 10%, 15, 20, 25%, and have been there for quite a while. Again, this is a very good thing. This means that a lot of the heat has been taken out of these stock prices. A lot of the things that make for bubblicious behavior have been undone through the sell-off. And so we're establishing a new base from which we can see a subsequent rally. So I know it's a bit painful when you're going through the correction, but again, this happens all the time. I sold off some things, as I mentioned earlier in the video, and I used that money to acquire a few positions. So I've been building on some of the positions that I already had, but I've also re-added Square, one of my favorite businesses that has spent many months consolidating in terms of share price. So this is a very high growth company, payments company, and the share price grew very fast through last year, and now the fundamentals have been catching up while the price stayed more or less as is since, let's say, December-ish, end of December. Despite this, the company is still forecast to see massive growth through the coming years. So I took the opportunity to re-add my first position. I've had some very successful trades with Square historically, hundreds of % in terms of gain. I've also re-added Facebook. I was lucky to sell Facebook more or less at the peak before it dropped. It's seen a pretty big drop over the past few weeks. And I've added my first position there, as well as a position in Coinbase, which is the first time I'm buying in there. Right, then finally, for the US, we saw Micron. I don't have a tab open for it, but we saw Micron, $MU is the ticker, report earnings last week, and the earnings for the quarter gone were amazing. But they did say that for the next quarter or two, there's going to be some softness in terms of demand for their products. And that's because there have been supply chain issues. The supply chain issues haven't been from their side. They haven't been from the supply side, they've been from the demand side. So PC makers, for example, haven't been able to complete building PCs, not because they can't get hold of Micron products, but because they can't get a hold of all of the products that they need to build a final PC and then sell it on. So they were very honest about this and expect there to be some softness for some time, but they also think that for the full year and beyond that, they're going to see monumental growth for a number of their products. The share price hasn't dipped very much since they announced that news, which makes me think that that announcement was more or less priced in. And I suspect from here on out, we'll see the share price of Micron wind up northwards through the coming months and quarters. Okay, and lastly, for the US, so on Friday, we got some pretty great news, which I don't think the market's made much of, which is that the ISM manufacturing PMI came in higher than expected, not by much. So this economic indicator is a leading indicator, so it tells us not about what has already happened, but it tells us a little something about what is yet to come. And it's indicating to us that there is still a decent amount of growth forecast for the US. So I suspect that some of the issues we see now will slow down growth around the world, but that growth is still there, which is great. Okay, and on to China. So China has lots of very interesting events just about every single week, and last week was no exception. So Evergrande continues to make headlines. It seems as though the government has directly and indirectly found ways to contain the fallout, to cushion the fallout, and to support the industry around Evergrande as well as their population. So we did hear a little bit about that, but the bigger hot topic was China's energy crisis. So in the same way that in the UK, we had to have a number of things happen in order to create an energy crisis. Within China, a different set of events had to take place, but they have taken place, and now China is having an issue supplying enough power to its entire country. And this is for many, many reasons, a combination of growth, shifting from fossil fuels to renewable energy, other kinds of infrastructure and operational challenges. This is a pretty good article, actually, that summarizes the issues. What is interesting is that the UK also relies on a lot of renewable energy. I think 40% of our energy comes from wind. And part of the reason that we're having an energy crisis at the moment is because there wasn't as much wind as we usually had during the typical windy period. And so, like China, we're having to turn to older, dirtier sources of energy, such as coal. And then there's a lesson somewhere in here that our world needs to lean on, unfortunately, these dirtier sources of energy whilst ramping up renewable energy capabilities. Obviously, the path from something as deeply ingrained as energy from one fuel source to a completely other type of fuel source is going to have some challenges along the way, and these are beginning to manifest. But we'll get past them. Chinese stocks have not liked this news, though, and so I've pulled up two ETFs here. The first is an ETF that mirrors the CSI 300. You can kind of think of this as the S&P 500 within China. And from the highs in February, we are now sitting pretty close to the lows for this year. And this is a drop-off of, what is that, nearly 20%. Now, if we take a subset of the CSI 300, which is called China Internet, specifically those technology companies, we can see a far more dramatic picture. So a fall in the ETF price from $104, dollars, all the way through to $45 that we see today. So it's less than half of the value. Some of the recent negative price action has been very, very recent in the past few trading days. So China just keeps on being hit by bits and pieces of bad news, sometimes on purpose. For example, the new legislation that keeps on coming, and sometimes by other kinds of operational challenges like Evergrande, and now the energy crisis. The stock prices within China, by the way, I think are some of the most obvious opportunities that you have right now anywhere in the world. The challenge is that investors are not going to make their way back into Chinese stocks until there's some kind of an all clear. What I mean by that is there's a little bit more certainty that less legislation is going to be coming through, or that we are approaching the end of the long list of industries to be legislated. I don't know if that's a word. And so almost everyone I know that is an investor wants to pour money into specific Chinese stocks, but because we could be waiting months for this to turn around, they just aren't at the moment. However, what that means is that when it is clear that sentiment is shifting for China, I think that there's going to be a huge inflow of money into Chinese stocks, which is going to mean that they're going to pop quite high and quite quickly. So how long do we have to wait for that? I don't know. But for now, as I say, just about every week, I'm keeping my allocation very small, less than 5%, I think, at the moment. Something to note is that China is closed for business, by the way. So since Friday last week and through most of this week, we won't be seeing much action out of China. All right, what about this week? So there's a smattering of economic data this week for the UK, the US, as there usually is. Some of it could move the market. You can see some of these things are fairly important to the market. However, I feel like sentiment is already pretty negative given the September that we just had. And so we would need some pretty negative surprises in these numbers to send the market any further south. Just my opinion. In terms of earnings, it's earnings season again. It happens a little slowly initially. So you can see there are a few companies reporting this week, and then it accelerates towards the middle of the month and then picks up speed. There are more than a few of my companies that will be reporting in the second 2 weeks of October. Just be aware of that. So we probably will see a bit more volatility. I think what will make this quarter particularly interesting is that I think we are in peak supply chain issues right now and have been for a few months. I expect that will have negatively impacted the earnings of many, many companies. The market is a mechanism for trying to predict the future. So if the forecasts from these companies are positive, even if the quarterly earnings looking backwards are a bit negative, the market will probably shrug those off. And we are officially in Q4. So Q4 is the shopping quarter. And you can see we have events, shopping holidays. It makes me cringe that they're called shopping holidays. But we have Singles Day, Thanksgiving, Black Friday, Cyber Monday, Christmas Eve, Christmas Day, Boxing Day, which are all days where the retailers will have massive sales trying to capitalize on people's willingness to part with their money. Obviously, this means that retailers are going to have a pretty good quarter. And all of the different businesses involved in that kind of area will also probably do quite well. So we're looking at businesses that handle payments, for example, Square, Visa, MasterCard, delivery companies, etc., etc., etc. Many investors, institutional investors and retail investors will know, experienced retail investors will know that this is happening. And so I think we will see stock prices of those companies tick up through the next quarter. All right, that is it for this week. I hope you have a great trading week, and I will talk to you next Monday. Goodbye.